Okay, let's unpack this. Welcome back to the deep dive. We're here to, get past the usual stuff and pull out what really matters from documents that have real weight.
Yeah, documents that tell a story.
Exactly. And today, we're diving into one that might seem a bit old school at first. The Markel Group's 1990 shareholder letter.
1990 sounds like ages ago, right?
It does. But trust me, this isn't just some dusty relic. This letter gives us a really cool look back, an early peek into how a company famous for long-term thinking, thought, our mission today, pull out those key bits of wisdom, the nuggets, and give you a shortcut to understanding the core ideas that really built Markel.
And that's why it's still super important for you today. It doesn't matter if you're investing, running a business, or just, curious about how lasting value gets built.
Yeah.
These letters, especially from companies like Markel, they give you a real inside look. It's not just the numbers, it's the philosophy, the strategy, the challenges they face.
It's like a blueprint, almost.
It really is. A blueprint for building something for the long haul, for allocating capital smartly. Things that are honestly timeless principles you can apply yourself. It shows how they started laying that foundation.
Okay, so here's where it gets really interesting for me. Reading this 1990 letter, what jumped out was how clear they were about who they were, even back then. How did they talk about their game plan in such a crowded insurance market?
It's fascinating, yeah. They didn't mess around. The letter flat out says they were focused on several segments of the insurance industry and specialization in certain niche markets.
So not trying to be everything to everyone.
Not at all. It wasn't about being the biggest generalist because, that often just means you compete on price, right?
Yeah, race to the bottom.
Exactly. They wanted to be really good at what they did, focus in specific areas, like avoiding the big messy ocean and finding those smaller streams where their expertise really mattered.
Makes sense. Build a moat.
That's the idea. Build knowledge, relationships, something defensible. And they even mention using IT information technology, which was pretty forward-thinking for 1990, to help run that specialized approach efficiently.
And they talked a lot about partnerships, right? Like Shand Evanston and Fairfax and Lindsay and Newman. What does that tell us about how they actually ran things, how they chose to grow?
Yeah, that tells you a lot. Their model wasn't traditional, not just growing from within. It was very much about smart alliances, strategic acquisitions that fit that niche focus.
So buying expertise.
Buying expertise, buying market position. They were focused on marketing and underwriting specialty insurance, totally different from a volume game. And the quality of those partnerships. Look at Prem Watsa.
And Fairfax.
Yeah, the chairman of Fairfax Financial. He stayed on Markel's board. That signals a really deep aligned relationship, not just a casual thing. And Shand Evanston, they called it a premier specialty insurance underwriting organization, the largest business in its category. Things like professional liability. So Markel was basically collecting these pockets of deep expertise.
Building a network of specialists.
Precisely. They were buying established players in complex areas where knowledge was the real advantage, not just chasing easy market share. They were gathering talent and strong market positions.
That focus.
Yeah.
It's such a contrast to today sometimes, where everyone wants to be a generalist. It makes you think, doesn't it?
Yeah.
For you, the listener, where's your niche, your unique, defensible spot?
Yeah.
Whether it's in your career or a business or even just the skills you focus on. That depth, that expertise seems like it builds a kind of resilience that just being broad maybe doesn't. Okay, so they had this niche strategy. The big question then is, how did that actually show up in the numbers, especially in 1990, which had its economic challenges? Let's kind of dig into the financials.
Right. The numbers tell a story. And it's a story of, significant growth, but also dealing with some tough times.
Growth first.
Yeah, they reported significant growth in brokerage, mostly because they bought Rulin Agency the year before in late '89, so a big jump there.
Okay.
But here's the really crucial part. They had good underwriting contribution and very favorable results from their underwriting units.
Meaning they were actually making money on the insurance itself before investments.
Exactly. They highlighted their combined ratios 80% in 1990 and 79% in 1989.
Wow, low 80s. Wait, under 100 means profit, right? So 80s is really good.
It's amazing. Seriously, for insurance, especially while growing, getting combined ratios like that is exceptional. It screams discipline.
How so?
It means they weren't just writing policies left and right. They were choosing risks carefully, pricing them right, managing claims tightly. It's that niche focus paying off in the core business, a real hallmark.
But you said tough times, too.
Yeah.
1990 wasn't all sunshine, was it? The letter mentions the stock market decline. Unrealized losses. How did that hit them?
Yeah, absolutely. The market did take a dive. Things like the Iraqi invasion of Kuwait didn't help sentiment. It hit Markel directly. They had a $5.1 million loss from Fairfax shares they surrendered in a deal.
Ouch.
And on top of that, by year-end, $10.4 million in unrealized losses on their equity portfolio.
Unrealized meaning the value dropped on paper, but they hadn't actually sold.
Correct, but it still mattered. The letter says it was a direct reduction of shareholders' equity. So the company's book value took a hit from that market volatility. Even a great underwriter can't escape the broader market completely.
So speaking of investments then,
Yeah.
how do they manage their capital through all this? Did the market drop, make them pull back?
Yeah, this is where you really see they stuck to their guns, their long-term view. It's fascinating. Despite that market drop, their investment portfolio had actually grown massively.
How much?
From $66 million the year before to $360 million.
Oh.
And get this, they put another $69 million into equity securities. They explicitly said they believed equities would provide the greatest long-term rates of return.
So they saw the dip as a buying opportunity. Classic value investing.
Totally. They looked way past the current turmoil. But crucially, they weren't reckless. They also noted their long-term debt had gone up to $127 million, mostly from buying Shan Evanston.
A strategic move, but still debt.
Right. And they didn't just ignore it. They clearly stated their goal to significantly reduce the amount of debt and operate in the future with less leverage.
Okay, so balance. Use debt for smart growth, but plan to pay it down.
Exactly. It shows how they balance things out, long term, willing to use leverage strategically, but aiming for resilience by not staying over-leveraged. It wasn't about being cheap. It was about keeping options open for the future. That's a huge lesson.
It really is. And the letter also mentions these intangible assets. What were those about? Sounds a bit abstract.
Yeah, it does, but they were super important strategically. Totaled about $71.5 million from acquisitions. Not physical stuff, but valuable nonetheless.
Like what?
Okay, so policy renewal rights, $16.4 million. Basically, the right to keep insuring existing profitable customers. Think recurring revenue.
Oh, sticky business.
Exactly. Then non-compete and non-piracy agreements, $19.1 million. That's protecting their turf, keeping key people and clients after an acquisition.
Makes sense.
And goodwill, the biggest chunk at $35.8 million. That's the premium paid for the brand, the relationships, the know-how that you can't just list separately.
So the secret sauce.
Kind of, yeah. Even though they had to amortize these, write them down over time on the books, these intangibles represented the real strategic value, the future earning power they were buying. They weren't just buying assets, they were buying advantages.
That's a really sophisticated way to look at acquisitions. This whole section makes you think, doesn't it? How do you balance that drive for growth, buying things, investing in stocks, with being genuinely careful about risk, like wanting less debt? What can you learn from that for managing your own stuff, your own resources through ups and downs, for finding that sweet spot?
It's the million-dollar question, isn't it? Ambition versus prudence. Markel seemed to have a good handle on it early on.
Let's shift to the people behind this. Who was leading Markel back then, and what does the letter tell us about, their style, the culture they were building?
Well, the letter mentions Alan Kirshner as president and chairman and Anthony and Stephen Markel as executive VPs.
Strong family connection still.
Very much so. And that often gives a company that, long-term family feel, a stewardship focus. They specifically mention wanting a simpler business and financial structure after doing some complex deals.
Getting back to basics.
Sort of. It feels like a focus on clarity, efficiency, making sure everyone can focus on the main thing. And what was that main thing? The letter emphasizes acquisition of market leadership through excellent service.
Not just size, but quality.
Exactly. It suggests a leadership team that really valued doing things well, building relationships, satisfying customers. That was the path to sustainable leadership in their view, not just aggressive expansion. Reputation mattered.
And the letter wraps up feeling pretty positive, right? A sense of enthusiasm and confidence for 1991. What was driving that, do you think? Especially after mentioning those market challenges.
Yeah, it's a strong finish. And I don't think it was just, saying what you're supposed to say in a letter.
Not just corporate speak.
No. It feels rooted in the culture they were building. The letter kind of points to these emerging themes: integrity in business operations, and that discipline reflected in both underwriting and investing.
The core principles.
Those were the pillars, what they actually did day to day. The confidence wasn't just about hitting next year's numbers. It was a deeper belief in their whole approach, their strategy, their values. They believed they were building something solid, even if it took time.
Like laying a strong foundation.
Precisely. Knowing that foundation would last, even if the immediate results weren't perfect yet, it was about building this fundamental way of thinking based on prudence, ethics, consistency.
That kind of steady confidence, even when things are tricky, is powerful. Makes you think, for you listening, how much impact does leadership communication have? Especially in tough times.
Huge impact.
How it shapes morale inside, and how investors or partners see the company outside. What parts of that Markel style, the clarity, the integrity, the long view, resonate with you? How could you use that in your own life? Hashtag tag outro.
So, wrapping this up, what's the big takeaway for us today? We've gone deep into Markel's 1990 shareholder letter. It's this amazing snapshot, right? A company really building for the long term.
Absolutely.
We saw them sticking to their niche strategy, that incredible underwriting discipline, making actual profits, how they handled investments and debt strategically but carefully, and that strong values-based leadership.
And the lessons are still so relevant. For you listening, whether you're an investor, entrepreneur, or whoever, it really hammers home the importance of patience and discipline, doesn't it?
It shows that choosing focus is more important than chasing trends, especially a focus that lets you build something unique. And maybe the biggest thing, realizing that how you allocate capital, time, money, energy is maybe the most important job you have.
Yeah, capital allocation.
It's all about building something sustainable, something that lasts. Even if the immediate results, the numbers right now, don't quite match up with short-term hopes or market noise.
Okay, so here's a final thought to leave you with. That 1990 letter, they admitted their financial results are short of our long-term goals. But
they believe they had truly positioned itself for the future.
Exactly. So the question for you is, when you're looking at success in your own life, your work, your projects, how much do you weigh the results you can measure right now, this year, versus the strategic moves you're making, the foundation you're laying for the long term?
Yeah, how do you define real progress, especially when the numbers right in front of you might not tell the whole story yet? Something to chew on.